Just a quick heads up before we dive in. This is purely for informational purposes and is definitely not financial advice. Every investment carries a serious risk of loss. Now, with that out of the way, that title you're looking at, that is not hyperbole. We are staring down a structural shift in global energy that the retail market has not even begun to price in. And today we're going to break down the hard, quantitative case for why smart money is taking the other side of that trade.
Hit the like button, subscribe, and comment your top tickers right now. Retail is buying the market rebound, but under the surface, S&P 500 breadth has completely collapsed. Today, we expose how Wall Street is using political ceasefire headlines as a smokescreen to secretly short the consumer and hoard domestic energy ahead of a 50-year supply shock. All right, let's get right into it. The entire bull case for the S&P 500 right now, it's resting on a grand illusion. While that headline number looks pretty stable, maybe even strong, the internal structure is literally rotting from the inside out. This is what we call the breadth collapse, and it's the first critical piece of data that institutional trading desks are all over. Okay, this slide right here tells the whole story. On the left, you've got the market cap weighted S&P, the SPY. Looks resilient, right? Kind of flat. This is the illusion that retail traders see. But on the right, that's the equal weighted index, the RSP, and it is in a clear, undeniable trend breakdown. This is the reality. A handful of mega-cap tech stocks are masking the ugly truth that the average stock is rolling over and rolling over hard. And here's the number that quantifies that decay. Just a couple of months ago, 70% of the stocks in the index were in long-term uptrends, trading above their 200-day moving average. Well, today, that number has plunged to just 53%. So think about that. Nearly a fifth of the S&P 500 has broken its long-term trend while the index itself has barely moved. This is a classic high-level divergence that screams a major correction is coming. The components are failing.
So why is this even happening? Well, look at this chart. We have almost never seen a confidence divergence this extreme. The dumb money index, which tracks retail sentiment, is at a frothy 0.8. We're talking extreme optimism. They are buying this dip with record inflows. But meanwhile, the smart money index, tracking what the big institutions are doing, it has completely collapsed into the 0.3 to 0.5 range. That is deep structural pessimism. Institutions are not buying this. They're net sellers, and they're using retail's optimism as their exit liquidity.
And here's the fundamental why behind that pessimism. It's the CapEx conundrum. Look, big tech is dropping over $650 billion on AI infrastructure, but the market is done just giving them a premium for it. Now, the market's asking, okay, but what's the ROI? And the answer so far? The MAGS ETF is down over 10% year to date. Now, contrast that with physical energy. Their capital spending converts directly into margin from higher oil prices. There's no guesswork. The result? The energy sector is up 33% year to date. Capital is rotating from narrative to certainty. So, okay. We have a market that is internally weak, propped up by a story about infinite tech spending. What's the catalyst that's going to break it? It's not going to be earnings. It's the massive, completely unpriced geopolitical shock that algorithms are trading on this very second. This is the reality the market is choosing to ignore. In plain English, this means Wall Street algorithms don't care about political negotiations. They see the largest oil shortfall in half a century and are rotating out of vulnerable sectors like airlines to hoard the physical U.S. utility grid and domestic oil monopolies. It's a simple, brutal, quantitative trade based on supply and demand, not headlines. And just look at the scale of this disruption. This comes directly from the Dallas Fed, by the way. A full shutdown of the Persian Gulf removes nearly 20% of global oil supply. This is not some minor hiccup. It is the single largest geopolitical oil supply shock in modern history. We're talking 2 to 3 times larger than the crises in 73 or 1990. This is the 50-year event. And you have to see how fast this escalated. February 28th, the strikes begin. By March 3rd, that's just a few days later, the insurance market effectively closes the strait. 5 days after that, Brent is already over $100 a barrel. And by March 13th, less than 2 weeks in, it's being called the largest disruption in history. The velocity here is absolutely staggering, and the broader market has not caught up. And what is so crucial to understand here is the mechanism. This wasn't just a military blockade. No, this was the deployment of the insurance weapon. A small committee in London, the JWC, redesignated the risk profile for the entire Gulf. Insurance premiums shot up 60-fold, which made transit commercially impossible. The strait was closed by commercial logic before a single mine was even in the water. This is a totally new form of economic warfare, and it is brutally effective.
Before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits.
All right, so given this backdrop of a weak market and a massive external shock, how is smart money actually positioning itself? There are three main scenarios we have to map out. This is the institutional playbook. First, the bull scenario for this thesis. Negotiations fail, the blockade holds, oil breaks decisively above $100 and just goes parabolic. Then you have the bear case. A coordinated SPR release temporarily collapses that geopolitical premium, sending energy back down to structural support. And then the black swan, a full kinetic blockade. This would trigger a global sovereign liquidity freeze, a market-wide gap down, and a panic flight into physical domestic assets. So the institutional rotation is actually pretty simple and direct. They're going long domestic energy, like ExxonMobil, to capture those crude margins. They're long the physical AI layer. We're talking power providers like Vistra, who are basically stagflation-proof thanks to long-term data center contracts. And on the short side, airlines and consumer discretionary, which get absolutely crushed by higher fuel costs and inflation. And finally, shorting the S&P 500 itself, selling an overvalued index with collapsing breadth.
Look, this is a high volatility environment. Executing the trade is only half the battle. Defending your capital is paramount, and that requires a non-negotiable risk protocol. These are not suggestions. These are mandates. Mandate 1. All entries must have OTO brackets. That means you define your profit target and your stop loss before you ever enter the trade. No exceptions. Mandate 2. Use a dynamic trailing stop. A 2.5 times average true range stop will give the position room to work, but it'll also protect your capital from a sharp reversal. And Mandate 3, this is an absolute. Do not buy any asset under any circumstances that is trading below its 200-day moving average. In this environment, you are only long strength and you are only short weakness, period. So if you want to trade with a quantitative edge, hit like, subscribe, and comment below. Is the market pricing in a 50-year energy crisis, or is this the biggest institutional headfake in history? Let me know your thoughts on XOM and VST. Trade smart.